It's KBKW's Coffee Talk. It is now 7:13, and with us this morning is financial expert James D. Virgilio. Good morning to you.
Good morning, Doug. How are you?
I'm doing pretty good. It was an interesting night last night watching what was happening during Super Tuesday, and one of the things that we were going to talk about today is how does the president influence the economy? And so I'm curious on what your take is on perhaps some of the candidates that we have that perhaps can become president, and then the president himself. What are some of the ways that a president can cause issues or fix things when it comes to the finances of the country?
Well, that's a great question, and I think it's important first to start off by looking at the fact that really up until the 1920s, the president didn't influence the economy at all. In fact, it was common medicine for the president not to even make comments about what was happening in the economy. Obviously, things have changed a whole lot since then. If you narrow this down to really three candidates now, I think especially after yesterday, this seems rather prudent between Biden, Bernie Sanders, and Donald Trump. You have a range of state influence or federal government influence. And if you look at something like student loans, Doug, you can see the differences right off the bat. Bernie Sanders wants to forgive or cancel all student loan debt as well as make college education free. Biden, being very much a centrist, wants to do really things that aren't that much different from what Donald Trump wants to do on education. And so it ranges from something that's similar there to then taxes, both on a state tax level, a wealth tax level, a federal tax level. There's lots of differences, and you can sort of scale these things between how socialist or how much the government's going to be involved in running things to, I'm not even going to say how free they are on Donald Trump's side, because Donald Trump's policies really are more centrist when it comes to socialist versus what you would consider to be a free market.
So, when it comes to like free college and paying off or forgiving these debts and things, with the national debt that we have in America, number one, is there any possible way it could ever be paid off? Which to me seems like a fairy tale if that statement could be made. What is your take on that?
Sadly, I'm with you. I think that the federal debt being paid off is something we probably won't ever see. One, it's not in politicians' best interest anymore. Entitlement programs make up almost 2/3 of the government's budget. Those are increasing, not decreasing. Programs like Social Security, welfare, Medicare, Medicaid, et cetera, they take up too much of the budget. And once you have those programs in place, they're very, very hard to unwind or even reduce. So the federal deficit is here to stay. And on top of that, you see a lot of the monetary policies that are influenced by that. Having low interest rates actually helps a government who's printing a lot of money and borrowing a lot of money. And I think you're going to see those things continue to stay. None of the candidates, I would argue, are going to drastically change that. You're going to go from a Bernie Sanders who's really only going to increase the deficit significantly to a Biden and a Trump who are probably going to keep things the way they are, which is a growing deficit year after year after year.
Well, how long can that continue on before everything just goes down the tube?
That is the great question. That really depends on where you fall economically. Someone like me subscribes to what is kind of interestingly called the Austrian School of Economics, which is that the monetary policy, the deficit spending that we've been utilizing is in fact a house of cards. And at some point in time, you pay the piper. You really only have to look at Japan to see what happens when you've used up all of your stimulus. And at some point in time, your economy doesn't care anymore. Negative interest rates are an excellent example of this as well. You can only take this so far. It's sort of like taking steroids. You will get bigger. You will get stronger. There will be a short-term benefit. But in the long run, you will have to pay that bill, and the bill has become increasingly large, I believe, for our government as well as others across the world.
So what would be the outcome then? I mean, if you can't continue this, then you're looking in the future, depending on when this particular thing happens, there would be, a collapse of the economy?
I think, yeah, if you lose faith in, first of all, the currency, right? So the U.S. currency is backed by nothing other than the faith of the U.S. government. And if people begin to lose faith in that as a safety measure, which right now we're not quite near that, then you would see a collapse of a worldwide economy. Do I think we're close to that? No. A lot of economics in the modern sense is relative economics. So how strong is the U.S. compared to other countries? But as investors, everyone is looking to say, where's the safest place to put my money during any kind of recession or crash? And right now that still is the U.S. government. But as you're mentioning, there could be a time when that changes. Countries don't last forever. Certainly their safety and perceived safety does not last forever. And it would be, I think, foolish to think that the United States economy and government and debt is not going to, at some point in time, continue to erode confidence in the system itself. Now, that could take a very long time. But it would be foolish, I think, to say that we could just continue on the path we are forever. If you and I, on our own balance sheets, were spending tremendous amounts of money every single year and not bringing in enough to cover that, we would have some serious financial problems at some point in time.
Now, what about the COVID-19 issue? How do you think that's going to affect the economy? And I think some people feel that they're exaggerating the danger. Others feel that they're not giving it enough credence. What's your feeling about that?
I think that when you have a pandemic like this, even if I think the medical community has been rather clear that this is a low mortality event, however, it's a highly contagious event, it's probably going to be somewhere like influenza, not as bad. I think that what you're seeing happen is the extraordinary response that countries are having. Take Hong Kong, for example. Hong Kong just had one of the worst Februaries on record because they primarily shut their country down to quarantine and to keep people away from each other. You're going to see, I believe, an effect in the economy for the next 2 to 3 months with COVID-19 because you can't replace all of the productivity that's lost. I think the market's trying to figure that out right now. As far as is it over or over widespread, or is there too much panic? Probably. Markets are prone to overreact to emotional news like this. I think that we're in for a choppy, probably 3 to 4 to 5 months. Springtime, hopefully, Doug, will help us, as it tends to with diseases or viruses that tend to be systemic in this nature. And in fact, if you go back and look at all of the viruses or diseases that hit, whether it be SARS or Ebola, within 6 months, every single one except for Ebola actually wound up having a positive U.S. stock market return. So it tends to process the information rather quickly.
Now, I saw one of the leaders of Hong Kong. It was on the Bloomberg channel, and I didn't get what his position was, but he was high up. And they're going to look at giving each person in Hong Kong $10,000 to spend to get the economy back to some form of normal. Did you hear about that?
I didn't, but every time I hear something like that, it just makes me cringe a little. It goes back to John Maynard Keynes back in the 20s and 30s, convincing worldwide governments that the best way to fix problems is to spend yourself out of them. But to me, it's just such a silly notion. We do it here in the United States as well by giving money that the government doesn't have, right? The governments can only get money by taking money from other people. You're redistributing existing resources, which always, and this doesn't make people feel comfortable, mathematically, this always leads to a lower standard of living for those in the country. So redistributing wealth does not kickstart anything. It's a panacea. It's sort of a placebo effect to make people feel like, oh, I have extra dollars. But if you're counting up all those dollars and seeing where they go, it is not, in fact, a solution.
Well, at 7:22, we're going to take a quick break, and then we'll be right back with you.
Are you and your family currently experiencing homelessness or in a situation where you are losing your housing? Please remember that Family Promise of Grays Harbor assists families with our temporary shelter program. Solving homelessness is not just about housing. Our holistic approach to the crisis of family homelessness includes 3 key areas of focus: prevention, shelter, and stabilization. Our team can help support your family through this tough time with comprehensive, innovative solutions. Contact us today at 360-986-3948, 360-986-3948, or visit www.familypromiseofgraysharbor.org. If you or someone you know could benefit from our services or would like more information, you can also check us out on Facebook. While things go well for Family Promise of Grays Harbor, the need for volunteers, additional host congregations, and continued financial support remains great. Assistance of any kind is appreciated.
It's KBKW's Coffee Talk. 7:23 is the time, and our guest this half hour, James Virgilio, who is a financial expert, and one of the areas that you like to talk about are the millennials and how they use, save, or spend their money. And so what are some of the pluses and then the minuses for millennials?
Well, it's funny. Human nature is rather consistent. If you look at boomers or the greatest generation or millennials, they all exhibit very similar traits. The millennials are a pretty good punching bag for the media when it comes to finance. But in reality, they actually have a lot of good habits that you would expect. Millennials grew up with boomers as parents, and most of those parents were really the first generation to have to save on their own. And a lot of those parents encourage their kids to save money. And you see that with the millennials. In fact, they save at a higher rate than the boomers or Gen X before them. What they invest in, however, tends to be different. They're renting more than they are buying, which I think is actually a good thing, since home ownership is not a good investment when it comes to math. And that's something that's fun to talk about maybe at a different time. But I think whether you're a millennial or a boomer or anything else, the most important thing to do that most Americans fail at, in fact, more than 50% fail at this metric, is to save and invest at least 10% of your gross income. 10% of your gross income is by far the most important thing you can do for yourself for retirement. And millennials are not making the mark on that one, as any generation before them has not made the mark on that either.
Now, isn't the inflation, because I mean, okay, when I grew up, I was born in 1950, and so I grew up during that particular time. But over the years, it was a lot less expensive if you had a family to buy a house, daycare, and of course, health insurance and pharmaceuticals have gone through the roof, to where if you adjust for inflation, it still shows a huge amount of inflation over the years from what stuff really cost then and what it really costs now. How do you deal with that?
Well, that's a great point. That's a really interesting spending topic. We mentioned John Maynard Keynes before, but if you look at two of the highest inflation areas, it's going to be college education and medical spending. And why is that? Well, those are two of the most heavily subsidized industries that we have today. And when you get subsidized industries, you get skyrocketing costs because price no longer is really a deciding mechanism. The way to deal with inflation or rising costs, of course, is to invest. You really need to be investing a portion of your income in order to deal with these things. Companies are going to have to produce that demand. Obviously, you're going to send your kids to college. And if you just put money in a bank account or in a CD or in a savings account or under your mattress, that's not going to generate enough return. Inflation is going to eat away at that return, as well as these rising costs, as you mentioned. And we're left with little choice in our modern society but to have to invest in some rather risky assets. You know, you can't really just purchase a bond that gives you 5, 6, or 7% interest rate. You're going to have to invest in equities. You're going to have a good investment strategy. And a lot of these costs, as you mentioned, actually cause the retirees to have to invest in more aggressive portfolios as well. So there's been a shift towards everyone having to invest in assets that are more equity-based, which does, I think, in fact, exacerbate the boom and bust market cycle that you see right now.
So is there any way to dig out of this, or we just have to adjust? This is modern times, and this is how it's going to be, and figure out a way to make it the least amount of issue for a family. You know, figure out a way to make it more simple for you to live in this kind of environment, yet it's so much different from what we have to deal with from, what we worked with in the past.
It is, and I think the most important thing we can do as a family unit is control what we can control. You can definitely control what percentage of your income you're saving and investing. You can definitely control how much debt you're taking on. You can control whether you're buying or renting a house. You can control which account to choose for your 401k. Should I choose a Roth or should I choose a regular one? Those choices make big, big differences. I think one of the simple ways to combat this is to go see a fiduciary, a financial person who has to do everything in your best interest, has a legal obligation to do what's best for you, and to make sure you see a certified financial planner, someone who has a board-certified degree, and making sure they're planning for your future. There are steps you can take. I think what happens is people face all of these issues we read about in the news every day, and it sort of shuts us down. We think there's too many bad things going on. This problem is too big for me to solve. What's going to happen if college skyrockets? How do I pay for my kids to go to school? You really have to start very small and say, first, let's make sure that we're net savers as families. Let's make sure we don't overspend our means. Let's make sure we invest our resources, and over time, let's make sure we build wealth so that we can deal with the situations that come up politically or otherwise in our lives as we grow older.
Well, we're down to 1 minute left. How do people get in touch with you? Or I'm sure you have a website, and perhaps you've written books on this topic as well?
Certainly. My firm's website is cddwealth.com. So it's Chacon, Diaz, and Virgilio wealth.com, cddwealth.com. There's a plethora of articles and videos there on a lot of topics that we've talked about today that go much more in depth, things like should you buy or rent a home, which 401k should you choose, a Roth or a traditional, and other myths that exist in finance. Finance is interesting, Doug. It's often talked about, and a lot of the remedies or the prescriptions that are given are, in fact, not correct. And so I think we have to be careful to wade through to see what the data actually says, and the decisions we make will make a significant impact in our financial future.
Well, James, thank you very much for being with us. It's been rather enlightening to hear what you had to comment on today.
Thanks for having me, Doug. I enjoyed it.
You betcha.